Every economic downturn creates a new wave of millionaires. That's not hype, that's historical pattern. The question is, what strategies did those who profited actually use? And more importantly, why did those strategies work when others failed? This video examines 3 investment approaches that appeared repeatedly across documented market crashes, not advice, historical analysis. By the end, you'll understand the mechanisms that made these strategies effective, and why they worked. Market downturns trigger predictable human behavior. Fear takes over, portfolios turn red, the urge to sell everything becomes overwhelming. This panic destroys wealth, but it also creates opportunity. The difference is preparation. Historical data from 5 major crashes shows consistent patterns: the dot-com bubble, the 2008 financial crisis, the 2010 flash crash. Each downturn separated investors into 2 groups: those who panicked and sold, and those who followed specific strategies. The wealth transfer was massive, and it followed the same mechanism every single time. This video decodes 3 strategies that appeared across every documented crash. These aren't secret formulas, they're observable patterns. Understanding why they worked matters more than knowing what they were, because the mechanism reveals more than the action. Strategy 1: diversification across uncorrelated assets. The principle seems simple, but historical data shows most investors don't actually implement it correctly. Owning 5 different tech stocks isn't diversification. That's concentration with an illusion of spreading risk. True diversification means spreading investments across different asset classes, industries, and geographic regions. The mechanism matters. When one sector collapses, uncorrelated assets provide stability, not growth. Stability. During the 2008 financial crisis, this pattern appeared clearly in the data. Portfolios concentrated in financial stocks experienced drawdowns exceeding 70% in some cases. Portfolios holding utilities, consumer staples, and healthcare experienced significantly smaller losses. The reason? People still needed electricity, still bought toothpaste, still required medical care. Essential services maintained demand regardless of economic conditions. This created relative stability during the crash. The same pattern appeared during the dot-com crash. Technology stocks collapsed, energy and utilities held relatively stable. Not because those sectors were better investments, because demand for their products didn't disappear during recession. Government bonds showed similar patterns. During equity market crashes, bond prices typically rose as investors fled to safety. The 2008 data is stark. From peak to trough, the S&P 500 declined 57%. 10-year U.S. Treasury bonds gained 26% during the same period. The negative correlation provided portfolio protection. Precious metals showed mixed results. Gold gained during the 2008 crisis but declined during the 2010 flash crash. Initially, the pattern suggests gold functions as crisis hedge. In specific conditions, not universally protective. The mechanism across all cases remains consistent. When assets don't move in lockstep, portfolio volatility decreases. This isn't theory, this is measurable outcome data from actual market crashes spanning decades. Investors who maintained diversified portfolios recovered faster after every documented downturn. The data shows this clearly. Strategy 2: systematic investment during price declines. This strategy has a name: dollar cost averaging. But the name matters less than the mechanism. The approach is straightforward. Invest fixed amounts at regular intervals regardless of market conditions. When prices fall, the fixed investment amount purchases more shares. When prices rise, it purchases fewer shares. The mathematical result is an average purchase price lower than if all capital was invested at a single point. Historical data from the 2008 crisis illustrates this clearly. An investor who invested $10,000 in January 2008 would have experienced severe immediate losses. An investor who invested approximately $830 monthly throughout 2008 and 2009 achieved a lower average cost basis. By the time markets recovered in 2010, the systematic investor had substantially better returns. The same pattern appeared during the dot-com crash. Lump sum investors in early 2000 suffered for years. Systematic investors who continued through 2001 and 2002 accumulated shares at progressively lower prices. When markets recovered in 2003, their position was significantly stronger. The 2020 flash crash provided the most dramatic example. Markets fell 34% in weeks. Investors who maintained systematic purchases through March and April 2020 bought at generational lows. The recovery happened so rapidly that those sitting on cash waiting for the bottom missed the entire rebound. The mechanism isn't complicated. Systematic investment removes timing decisions from the equation. Investors can't predict the exact bottom. They never could. Historical data proves this repeatedly. By removing the need to time the market, systematic investment eliminates the primary cause of poor returns. Research from Vanguard shows lump sum investing outperforms dollar cost averaging approximately 2/3 of the time historically, but that statistic misses the critical variable, human psychology. The optimal strategy is irrelevant if investors can't execute it during panic. Dollar cost averaging provided psychological framework to continue investing when fear was highest. That behavioral advantage outweighed the mathematical disadvantage in real-world outcomes. Strategy 3. Shift toward quality assets and portfolio rebalancing. Quality has a specific definition in this context. Companies with strong balance sheets, low debt, consistent earnings, sustainable competitive advantages. During bull markets, investors chase growth and speculation. During downturns, quality outperforms. The 2020 crisis data shows this pattern clearly. Companies with high debt loads experience stock declines exceeding 80% in some cases. Companies with strong balance sheets and low debt experienced significantly smaller drawdowns. The mechanism is straightforward. Companies carrying heavy debt face refinancing risk during credit crunches. Companies with clean balance sheets and cash reserves survive, often emerging stronger by acquiring distressed competitors. Warren Buffett's Berkshire Hathaway deployed over $15 billion during the 2020 crisis, purchasing quality companies at distressed valuations. This wasn't market timing, this was capital availability when others faced constraints. The same pattern appeared in 2020. Companies with strong balance sheets raised capital easily. Companies with weak balance sheets faced bankruptcy. The wealth transfer was rapid and substantial. Dividend-paying companies showed similar patterns. Companies maintaining dividends through downturns provided returns even when stock prices fell. The psychological impact matters. Receiving cash dividends during a crash reduces panic selling behavior. This shows up in the data. Dividend-paying stocks experience lower selling pressure during market stress. Rebalancing creates the second component of this strategy. Market crashes throw portfolio allocations out of alignment. A 60-40 stock-bond portfolio becomes 50-50 after stocks decline. Rebalancing means selling the asset that held up better and buying the asset that declined. This forces investors to sell high and buy low systematically. The mechanism is simple but psychologically difficult. Selling bonds that maintained value to buy stocks that crashed feels wrong, but historical data shows this discipline produces superior long-term returns. After the 2020 crash, investors who rebalanced in early 2020 captured the entire recovery. Investors who didn't rebalance left money on the table. Their portfolios stayed too conservative as markets rebounded. The 2020 crash provided similar opportunity. Rebalancing in March 2020 would have locked in substantial gains by year-end. The pattern repeats. Disciplined rebalancing during panic produces measurable outperformance. Now let's examine what these three strategies mean when implemented together. Each strategy addresses a specific failure point in investor behavior during crashes. Diversification prevents catastrophic loss from concentration. Systematic investment prevents timing mistakes. Quality focus and rebalancing prevent panic selling. Together they create a framework that historically produced superior outcomes across every documented downturn. The mechanism isn't magic, it's behavioral engineering, removing decision points that humans consistently get wrong. Historical analysis from the past 5 major crashes shows consistent results. Investors who implemented all three strategies experienced smaller drawdowns and faster recovery than the broader market. The data spans .com crash, 2008 financial crisis, 2011 European debt crisis, 2015 China slowdown, and 2020 endemic crash. The pattern holds across different crash types. Technology bubble, credit crisis, external shock. The strategies performed consistently. But here's what the data also shows. Very few investors actually executed these strategies during the crashes. Panic overrode preparation. Fear overrode discipline. the knowledge existed but the execution failed. This reveals the most important insight from historical analysis: understanding the strategy matters less than having the psychological framework to execute it during crisis. The investors who succeeded weren't smarter, they were more disciplined. They had systems that removed emotional decisions, automatic investments that continued regardless of market conditions, preset rebalancing schedules that triggered mechanically, rules established before crisis that eliminated the need to make fear-based decisions during crisis. This is the real pattern from historical downturns. Wealth transferred from those who made emotional decisions to those who followed preset systems, not because the systems were complex, because they were simple enough to execute during panic. So here's what historical analysis reveals about market downturns. 3 strategies appeared consistently across every documented crash. Diversification across uncorrelated assets reduced portfolio volatility in maximum drawdown. Systematic investment during declines produced lower average cost basis and stronger recovery performance. Focus on quality assets and disciplined rebalancing forced investors to buy low and sell high mechanically. The data shows these strategies working across 5 decades of market history, across different types of crashes, across different economic conditions. The pattern remained consistent, but the data also shows something else. Most investors knew these strategies but failed to execute them. The barrier wasn't knowledge, the barrier was behavior. Fear and panic overrode preparation and discipline. The investors who succeeded used systematic approaches that removed emotional decision-making from the process. They built frameworks before crashes that continued operating during crashes. This is the consistent pattern from historical market analysis. Downturns don't destroy wealth, they transfer it, from the emotional to the systematic, from the reactive to the prepared. Understanding these patterns doesn't guarantee future results, but it reveals the mechanisms that produced historical outcomes, and those mechanisms remained remarkably consistent across every documented case. This is financial history decoded, pattern analysis of investment behavior during market crashes, based on documented historical data. If this analysis changed how you understand market downturns, consider subscribing for more historical pattern analysis.